Good afternoon. Thank you for joining us for Startup Portal's Equity Crowdfunding Summer Series. Today's second session talks about a company, Gesture US Inc., and safe agreements are the type of security that they use with the crowdfunding portal of Republic. My name is Rick Leinbach, founder of Startup Portal. I'm an outsourced CFO and former small public company CFO. Our goal is to get you from plan to profit, and we use cloud-based tools, virtual-based tools, and we really understand what it takes to raise capital. And certainly, I want CEOs of companies working on the business, not preparing financials. So ideally, for us, we focus on day one and year one to help you get to the next level, and really design for growth. And hopefully, we'll help you along the way. So with that said, today we're going to talk about the portal, talk about the company. We'll get in a little bit on the financial numbers, and then we're going to talk about the risk factors involved with SEC offerings and how you should describe them and really think about them. One thing to note, Startup Portal does not receive commission from any crowdfunding portal or any stakeholder. This is just for informational purposes only. Crowdfunding itself started obviously with individuals contributing money to companies and getting a product in return, or sometimes just to be nice. Equity crowdfunding allows companies to sell securities to that same crowd, to the individual crowd. And the transactions need to come through a funding portal. In equity crowdfunding, the max is $1.07 million a year. And also there's limits to investors over a 12-month period of time, typically based on their income. Lastly, your information is filed for a certain period of time with the SEC for full disclosure, and obviously through the diligence process to really tell your story. Equity crowdfunding for Gesture seems to be a pretty good fit, and using Republic as their portal allows them to raise capital today, and the safe agreements that they use are sort of pricing it tomorrow. Gesture itself is an app designed to provide gifting through the app and delivering those gifts within certain cities around the country, similar to an Uber. So they're, in my opinion, the Uber for gifts. So crowdfunding portals, the portals themselves, there are 50 plus of them. And I look at the portals as each one has its own business plan. As we'll see today, we'll talk about Republic, and their business plan is different than Fundopolis that we looked at last week, in that they work with certain agreements like safe agreements or rev share. Fundopolis was rev share last week, but here the safe agreements allows you to really get documented, invest your money, and hope the investment from a company standpoint can be favorably priced for everyone down the road as they're looking for their next capital raise. So Republic was founded by alumni of AngelList. The Jobs Act from 2012, they pride themselves on being part of helping the Jobs Act get formulated through Congress and obviously the SEC. The minimum raise for Republic is $25,000 up to the $1.07 million, and typically there are 30 to 60 day offering periods. Their fee is 6%, and they offer 2% security on top of that, or they ask for 2% security. CrowdSafe is primarily what I'm seeing from their agreements. Looks like they'll get into token and do some revenue share as well. And again, I can't emphasize enough that your business model really should match the portal's business model to hopefully have more of a favorable outcome in the type of investors you're looking for under their platform, as well as investors you can bring in with you. Republic prides themselves on the 3% applicants accepted. And really what I read into that is they do their diligence on companies. They want to make sure that the safe agreements that's their primary fits your business plan. And they're expanding. Fig.co is a company that they just acquired for video game investments. So I'm sure the platforms will converge within time if they haven't already. Just from a timeline, you can see they lay out on their website the diligence takes a week, onboarding 3 to 6 weeks where you get your financials ready, you get your marketing plan, you'll do a video about your company, and then you'll get filed with the SEC and get approval, and then the campaign will launch for 2 to 3 months, and hopefully they're successful in the launch and you close and become an alumni republic. With that said, let's take a look at the CrowdSafe offering that they offer. The safe part is a simple agreement for future equity. So the investor makes a cash investment in the company, gets the stock priced at a later date. So in some respects, I look at it as sort of getting engaged, however, not setting the wedding date, and trying to figure out down the road where it is. So it's something that helps the company where you sort of formulate the agreement, get the cash on board, and start operating without having to worry about the nuances of pricing, the agreements, and the next round getting priced and repriced. So it's really very favorable to the company. And the modified or the CrowdSafe agreement from Republic fits very well to help companies that have a good story to tell raise capital. So let's take an example with Gesture's CrowdSafe agreement on how the conversion works. So what you're going to do is look at the value they've put on the agreement, the conversion agreement. Here it's $10 million. And you're going to divide that by the number of shares, and I just use what they've disclosed as 4 million outstanding to get a conversion price. So you're going to look at that $2.50, 10 million divided by 4 million gets you $2.50, or you're going to look at the lowest price security, which is that future equity raise, multiplied by 80%, which in essence gives you a 20% discount. So you're going to take the greater of those two numbers as your conversion, they say quotient, so as your conversion formula. So here you can see that the $4 is obviously greater than $2.50, and we're going to take that $4 and look at the amount that was purchased. I'm assuming $1,070,000. I'm assuming they raised the entire amount. Divide that into the $4 conversion price, gives me 267,500 shares, which is a little over 6% of the post-conversion ownership. Now the interesting thing, you can see the 20% discount here based on the fact that the market value of that next offering is $5. The conversion of the securities, once you conversion the $1,070,000, gives you in essence 1.3 million of value. So that's where the 20% discount comes into play when looking at the actual agreement itself. And again, that market value is hypothetical down the road. However, it reflects, hey, this is how we would convert out as the company gets a larger financing in place. And that's the criteria, would be a large financing, either $5 or $10 million in addition, or a liquidation type event that may occur where someone comes in and buys them out. So you would still do a convert out to have the investors get their money back as well as at least a discount. Here are the offerings that Republic has out on their website. As you can see, for example, the Pure Green franchise has fulfilled the offering amount for current year. They had 4,700 investors, average of $227 per investor. So based on this list, you can truly see the crowd, individuals are investing in these companies. So it's very beneficial for the companies that can raise the $1 million in year one without, as I mentioned before, going through the pricing of saying it's whether it's a $4 or a $5. So they really can focus on the business, sign the safe agreements, focus on the business to really elevate their value and get to the next level. The fee breakdown is a comparison. I mentioned it before, but you can see Republic, their 6% and 2% placement and equity fee, respectively, is comparable to others. It really, again, it depends on the business plan. And honestly, it depends on the strength of the portal itself. Cedar Vest and Start Engine, have higher fees, but they also may have a higher investor base. So obviously that's part of your diligence as a company, understanding, if I'm paying these fees, additional 1.5% might be beneficial. Here, I like Republic, the way they've priced their deal. I like the fact that allows companies, especially software-based companies, to put themselves in a position down the road of negotiating a price in lieu of already setting that fixed price. So that's really where the strength of it comes from. And the nice thing is Republic is very consistent, the types of deals that they're doing. That's their business model. Now, let's talk about Gesture US Inc. Gesture's based in New York. They have services in 31 cities. It seems like they have a pretty strong management team. And their model is to deliver happiness through modernized and simplified gifting. In essence, you go on an app in your city, you decide the type of gift you want to provide, and they have what's called G-runners who have their own app, similar to an Uber, to run the apps around the city. And it could be bike, could be car, but it's similar in nature in that they're matching delivery with the service itself, and obviously taking a fee on that. Now, their competitors, based on what they're saying on their website, you can see the big players out there, the established companies, the proflowables, edible arrangements, offerings that are already there, already have their own delivery vehicles, etc. They're focused in major cities. Obviously, their biggest challenge is their branding. How do we become one of the brand names out there? So that's really where I see the concentration of dollars and dollars from their investing, as well as developing their platform. So they go to direct to customer, B2B, and look at the Gen X and professionals, really that are used to using apps. Again, comparison to Uber, used to using the apps for services. So, now they're looking for minimum of $25,000. As of June 14th, they have $6K raised. You can check their website. They're looking to max out at $1,070,000 to hire staff, adjust their payment processing, which allows them to manage their orders with their customers, as well as the G-Runner app, other app in the payment structure. Obviously, marketing is going to be key for this company. Getting a presence, getting a name, getting solutions, and they mentioned their tech investment, really their app platform, building that out. And one interesting thing to note is I think they see they're looking for some products and inventory to have on demand. They don't profess profess themselves as a product company. However, it seems like there are probably some very consistent ordering that you could order in advance to have, just make sure you meet the high demands. Looking at the financials, the cash flow itself, this is from last year. You can see they used safe agreements successfully last year to raise almost $700,000. The cash today, June 2nd, was about $200,000. And you can see last year in the really the first year of up and running, the cash burn or net cash used in operating activity is about $269,000. So I would think that $500,000 this year at least it will be necessary in losses to fund the operations. It's losses, but it's funded by the capital raise. So getting and achieving $1,070,000 in capital will allow them to cover the losses. Because really, if you step back and you look, that they indicate they have 20 to 24% margins. So if you back that into revenue, how much revenue would you need to break even? You're looking at 1.3 to 1.2 million in revenue. And achieving that on an annualized basis with a company that's getting themselves out there, it's going to take a little time. So that's where the value of the safe investments and the funding come in, to allow them to build that brand presence, build the marketplace, and not be raising capital over and over and over to keep the funding going. So it allows them to really concentrate on operations. Stepping into the document a little bit, especially if you're looking at doing a crowdfunding raise. Risk factors. You can see in basically all SEC documents that are offering documents, you'll see that the SEC requires you to identify certain risk of your business and your financial condition. Here are some examples of limited operating history. It's common for many companies, especially ones that are starting out or just raising capital. Or with safe agreements. They're not freely tradable until a year from now. So you want the potential investor to understand that what you're investing in today really is not going to move for 12 months. So many companies want to look at their, obviously use legal counsel, but look at their business and what type of risk could you have in the business. A good example recently that I've seen from SEC clients are the coronavirus risk and disclosures have inundated themselves in SEC documents to let the reader know that a pandemic could happen again in the near term. So if you invest with us and it occurs, buyer beware. So that's really the point of the risk factors. When you're putting together the documents, you'll see that legal counsel is very good about helping you with those specific risks. However, it's still on you to make sure the business side of the risk are identified. So work with them, use other companies to compare, and really make that part of it. Does crowdfunding fit gesture using safe agreements? In this case, I truly think it does. I think it keeps the company in control of their equity, allows you to get the capital in. Gesture is scaling around the country. They're going to see cities, hopefully focus on generating revenue in those cities before they go further. But they have a platform that is scalable. The customer reviews seem to be very, very good on the app stores and the compliments of the customer service. And I guess the one big component here is they will need cash for their expansion and their operations. And the safe agreement seems like a pretty good way to do it. So with that said, overall, I'll look for some questions, and check us out next week. We'll continue our series on June 22nd at 8 p.m. Feel free to follow us, reach out to us, join our Facebook group for Equity Crowdfunding, and certainly look forward to seeing you next week. Thanks again. Take care.